How similar are the projections in a business plan you'd build for an SBA versus projections in a business plan aimed at raising other forms of capital? In short, if we are ready for SBA, are your services geared for other purposes?
It's a similar process, but with SBA, you have to come up with a set of assumptions with your projections of how you came to these projections. And what you want to be careful with is making sure that your projections aren't so rosy. They aren't so optimistic that it's going to be obvious to the lender that, hey, I've got 4 other coffee shops in my portfolio and none of them are doing anywhere close to this good, or they're all doing way better and you're not optimistic enough. So you want to make sure that the projections you're doing for an SBA loan are kind of within the realm of normal and industry standard. If you're trying to raise money from an investor, though, you may be trying to give more of that best case scenario. We would want to make sure, whether we're providing projections for a lender or an investor, that we're trying to do our best to be, realistic. But I do think there's a little bit of nuance there in how you would probably approach that. And I think the other thing I would say is that projections for the SBA, you are going to have things like that debt service coverage ratio that's like a specific kind of number that they're looking at. And they want to see you hit a 1.25 debt service coverage ratio within the first year of operations. Private lender or investor, they probably could care less about that. That's probably not something they're looking at in the same way. So some little nuances, but a similar process. And yes, we do almost half of what we do is for investors or, private lenders.